Hello, this is Craig Larson with Larson Financial Advisors on December 16th, 2014. Merry Christmas, Happy Hanukkah, Happy Holidays. Hope you're all doing well out there. So, what a difference a year makes. You know, last year at about this time on the video, we were talking about closing out 2013, and almost every growth category was up, and some areas of the market were up substantially. And this year has been a very different story, particularly in the last few months. Right now, the S&P 500 index is up 9.8% year to date, but small company stocks are flat, and junk bonds are down 2%, and the EFA, or the Developed World Index, is down 7%, and the Emerging Markets World Index is down 5%. So now we've had a bull market in growth assets for 5 to 6 years, and the leadership is waning, which is typically what happens towards the later stages of the bull market. There's less and less that's really working. So now is a great time for investors. Weed out your portfolio, reevaluate things, get rid of the weaklings. If you've got any losers in the portfolio, sell them for a tax loss. Rotate into the things that have strength. Okay. Now, a couple of interesting developments for 2014 now that I'm sure you've noticed. Number one, interest rates. Interest rates on government bonds has plummeted here in the United States. We started the year in 2014 with the 10-year U.S. government bond paying about a 3% dividend, and now it's paying about 2.1%. That is a huge move in a very short amount of time. We'll probably see a bump up in rates because it's gone so far, so fast, but the long-term momentums on rates are still down, so you want to be cognizant of that as rising rates or falling rates certainly benefit or harm certain aspects of the investment markets. I had somebody ask, hey, well, they couldn't go any lower, could they? Could rates go any lower? Well, so I looked in reference to some other primary countries around the world. What are their bonds paying? Well, if the U.S. bond currently is about 2.1, German bonds today are yielding about 0.66% on the 10-year bond. 10-year French bonds 0.93, and 10-year Japanese bonds 0.5. So rates theoretically could fall a lot more, and so be watchful of that and how that will impact investments. Now, secondly, oil has collapsed in price, and that has benefited us that buy energy, especially gasoline at the pumps, but it doesn't benefit everybody. One look at this chart. This was an oil chart that I printed off, and you can see it was well above 100 in July, and it just fell off a cliff here, so much so that the price of oil is way down here. I couldn't even fit the chart all on one page because it's done a cliff dive. So that's good for energy consumers, but it's not good for a lot of folks. Who is it not good for? North Dakota, Texas, Vladimir Putin, for instance. And by the way, Vladimir Putin has a big temper, and he's got a big arsenal. So this is a potentially very unhealthy event, especially for Russia. Their budget is paid for by 50% of the budget is paid for by oil revenues in that country. Right now they've got 9% inflation, and the ruble has fallen 42% just this year alone. So this will have some potential negative repercussions in some world markets that we want to be careful of. Which brings me to my next point, 2015. Be ready for some relatively quick and sudden changes. I think there's a lot of instability in the world. Even though U.S. stocks have been enormously positive, we're at the second highest valuations in history on U.S. stocks with a record amount of margin debt. And we've got a big slowdown in Europe. We've got a real estate bubble in China that they're trying to unwind gently. And we've got some just significant structural problems in Japan. So although the U.S. economy is strong, we need to keep our eyes on these other parts of the world because we're all interconnected now. So in 2015, we recommend that investors have a strategy that's flexible and adaptive and be prepared to make changes. So internally, what I'm doing for clients is we're watching these different categories and we rank them based on a mathematical trend system so that we can get out of the weak stuff early and we can get into the strong stuff early as well, and also have a risk management plan to protect money if things get ugly, which they might. So in order for you to have a happy holidays, feel free to put the burden on me, because I actually love tracking this stuff and I actually love watching it. So if you're not a client yet, please feel free to call me or email me, and we can take a look at your portfolio and give you a game plan and a second opinion. So feel free to call or email me. And in the meantime, have a very Merry Christmas and a Happy New Year. And I look forward to talking with you in the next few weeks again via video. Thanks for tuning in.